All right. With that, I want to take a moment to introduce our guest, one of our first guest speaker, James Thalacker, who is the Managing Director of BMO Capital Markets U.S. Equity Research Team. Mr. Thalacker is based in New York City and is primarily responsible for coverage of the domestic utility and renewable power sectors. He began his financial career in '95 with Dean Witter Reynolds, moved on to Bass Brothers, was a portfolio manager at Highbridge Capital, and for 10 years as portfolio manager with Millennium Partners. He's originally from Wisconsin, having graduated from the UW with both a master's and bachelor's degree, and currently resides in Far Hills, New Jersey. With that, James.
Thank you very much, James. And I'm just going to share the screen here, make sure that you guys can see everything. Please let me know. Can everybody hear me? James, can you hear me?
Yep, we can hear you.
Okay, can you see the screens too?
We can see you, but not your presentation.
All right, let me see. How's that?
There we go.
Okay, perfect.
Good,
Sorry about
thanks.
that. You think I'd be better at this? Well, thank you very much, James, for the invitation and the introduction. Again, my name is James Thalacker, and I'm an equity research analyst at BMO Capital Markets. What I really came to talk to you today is, my positive view on the utility group. It's a group that I've actually followed since 1995, and I actually think that the group's actually gotten better as a fundamental holding for investors. And I'm going to spend the first couple of minutes just kind of talking about how I think you should be looking at utilities in general, and then I'll go into sort of some of the current topics, as I see things developing right now. So just to start things off, again, you guys have already seen my CV, but very glad to be back. I miss Wisconsin immensely, and I'm very happy to hear that we have a Big Ten season again. Makes me very, very happy. So just to kick off the conversation, what drives relative performance in utilities? I really kind of bifurcate this in two places. In the pink box, we talk about just general macro issues, whether it be sentiment, the market's risk appetite, interest rates, global economic, backdrop. That will kind of tell you which way the group's going to move sort of, up or down. But what I'm really focused on is where are the best stocks within the utility group. So we call this relative value, which stocks are going to perform better relative to the others. So relative value within the group can be broken down into, I think, 5 main attributes. The first being earnings growth, the second being sustainable dividend growth. I can't emphasize enough consistency, balance sheet management, and then sort of geography and regulatory jurisdiction. So I guess just to start off with, start off with the earnings growth. I mean, the average utility grows at about 4 to 6% per year, and the companies that have performed the best in our group are the ones that actually have the most regulated businesses. So if you think of somebody that has a regulated profile of between 90 and 95%, those are the names that generally trade at the best growth rate. One of the things that we've seen over the last 10 years or so is the move away from central station, meaning generation builds, to what I would say is transmission and distribution focused capital spending. What that's done is it's actually taken a lot of the risk out of the capital programs for the utilities, and they're mainly focused on smaller, say $100 to $200 million investments, which from an investor standpoint actually de-risk the stories. The nice thing about the group is that there is actually no shortage of investment opportunities right now. We have a very, very aging infrastructure in the US, and transmission and distribution needs to be replaced. So the single largest constraint really to the growth rates for the companies right now has to do with keeping rates affordable to the customer, as well as being able to finance that. And in this case, it would be not as much access to the debt capital markets, but it's more about having to issue equity. Investors generally don't like equity issuances. So companies like your hometown company like Wisconsin Energy or Align tend not to have to issue a lot of equity. Those are viewed very favorably, and that's why they tend to trade at higher multiples than the rest of the group. Moving on to the dividends, the best stories are the ones that have dividends that are supported by regulated cash flow. And consistent dividend growth is definitely the key to the higher relative multiple for the utility. A below average growth rate or an elevated payout ratio generally translates into a discount for the group. And given the visibility, investors prefer a dividend that is supported by just the regulated entities within the company. So think about just the utilities themselves as opposed to potentially non-regulated entities. With the average payout of the group now at about 60 to 65%, dividend growth has generally been in line with earnings growth. So you're actually seeing 4 to 6% dividend growth, which is a very important part of my overall thesis. The next two slides I can't stress enough. Consistency, consistency, consistency. I mean, it's the same way in life, but it's very true in investing. The premium valuations in the group are directly correlated with management's consisting not only in their business strategy, but also in the execution of that business strategy. Just looking at the strategy part, over the last 20 years, the group has gone through several rounds of strategic realignment, ranging everywhere from legislative mandated separation of generation. This was deregulation. You saw it in the state below you in Illinois, to various and usually disastrous experimentations in diversification, whether them buying European utilities, very large merchant development programs, energy trading and marketing programs. And of course, we've seen a very steady cadence of M&A in the group. When I started, there were almost 60 plus utilities. Now there's, depending on how you classify them, there's probably close to 35 to 40 names. So we've seen a lot of electric to electric M&A, electric to gas M&A, and now what we call the unmentionable energy convergence phase is where regulated companies would buy unregulated gas distribution, or they would buy, things like airplane leasing businesses. After two distinct back to basic movements, the group is now primarily regulated, including assets that are dubbed utility-like. We do not think this will change anytime soon, and actually is very positive for the group overall. Turning to the other part of the consistency is execution. This is generally measured through meeting or exceeding your annual EPS growth rate, although the quality of those earnings is also very important. So companies that tend to have a lot of one-time items, or they are, booking earnings that not necessarily are related to their regulated businesses, aren't viewed very well. Likewise, the management of the regulatory and political relationships is very important to the multiples across the group. A consistent regulatory policy, and when I talk about this, I'm thinking about sustainable return on equities and equity layers, and the company's ability to earn their allowed ROEs are very, very crucial to earnings growth and their multiples. Looking to companies with states like Wisconsin or Michigan, progressive regulatory policies include sales decoupling, CapEx trackers, performance-based rate making, and things like ROE bands are viewed very, very favorably. But I would really stress this last point, which is customer affordability and service quality are probably the key to a company's regulatory and legislative relationship. And you will see the companies that do the best are the ones that manage these relationships the best. Again, the nice thing about Wisconsin is your local utilities do a fantastic job of this. Finally, geography, and this really just deals with two things. This deals with top line sales growth, and this again goes back to the regulatory environment. Sales and customer growth and mix are very important differentiators between stories. Utilities generally don't have a lot of top line growth anymore, meaning revenue growth is pretty low. This is generally due to the fact that we've got a slowing economy, slower GDP. We've also got energy efficiency programs. So really the fastest growing regions you see in the US now from a sales growth is the Southeast, the Southwest, and Texas. These are generally viewed more favorably as long as the regulatory backdrop remains intact. But again, I will come back to my previous comment that policy consistency and the application of progressive that add visibility to earnings and a company's ability to achieve its allowed ROEs are definitely the parts that really determine a company's relative value. In my view, the most favorable jurisdictions include Wisconsin, Michigan, Florida, Georgia, California, Pennsylvania, and Alabama. Finally, let's just go to balance sheet management. I'll skip over this a little bit, but I think having a healthy balance sheet and having a healthy capital structure is very important, not only to an investor, but also to your regulator. So most companies have done a very, very good job of making sure they're well equity capitalized. And I think the thing that I really want you to take away from this slide is that the proactive managements will issue equity when they can and not when they need to. They don't get behind the 8 ball and have to issue equity at levels that, actually impede their ability to grow. What we have seen over the last 4 to 5 years is companies, because the utilities have been fairly strong, have been very, very good about managing their balance sheets through equity issuances. So let's go to, our view on the group in general. We initiated coverage of the US sector at BMO in February of 20. We literally initiated at the very, very top of the market on February 19th. But our view still remains very, very constructive, and it was basically underpinned by 4 core points of view. One is investors' demand for yield is global in nature, and there is a shrinking inventory of real yield. 2, utility fundamentals are attractive, and they support an 8 to 10% total return. 5 to 6% of this is from earnings growth, and 3.5% of this is from dividend growth. And again, I'll highlight that the utility dividends are growing at 5 to 7%. 3, utilities are one of the only beneficiaries of the shift to climate change or ESG investing. That's environmental, social, and governance investing. And this is increasing, and the increasing global decarbonization momentum in the group is actually making utilities even more special. Finally, there's been an expanding sponsorship from foreign and passive. Think about passive as exchange traded funds or ETFs. These will continue to support the group in general. So just kind of breaking down each one of these really quickly, my basically core tenets for my positive view is that we're in a lower for longer yield environment, and this has created a real issue for institutional as well as retail investors for managing their liabilities. The investors' demand for real yield is global. This is not just a US phenomenon. If you look at Europe, they have negative rates. And the problem is you have a shrinking inventory of quality liquid yield. There just isn't enough corporate bonds or with decent yields, and there's plenty of sovereign or government bonds, but they yield almost nothing. So what this is doing is forcing investors to look at alternative sources for their income, and including utilities for their dividends. We also think the other part, as I said, we think the utility that supports our positive view on the group is utility fundamentals remain very, very attractive. The sector's fundamentals have continued to improve over the last 7 to 10 years as the group has become more regulated and organic investment opportunities have improved. Again, as I said, companies are moving away, whether it be Wisconsin Energy or if it's, XEL or even Alliant, you don't see them building a lot of big generation anymore. They're generally building wind. They're investing in transmission, distribution. AMI is automatic meter reading. It basically allows them to tell you when you have an outage. And smart grids, which can self-heal themselves. As I said, the largest constraint to the ability to grow right now is the impact on customer rates and the need for equity financing. I want to stress, capital opportunities are not the problem here. It's the companies continuing to make these investments affordable for you and making sure that they also improve efficiency and cost. In this slide, just real quickly, all I wanted to highlight is that if you look at the 10 and 30-year yields across, and these are government bonds, the top is the 10-year, the bottom is the 30-year. If you look over to the right-hand column yields, you can see that most of the yields right now are below 1%, and in some cases, they're actually negative. This is a very, very important point, is that the focus on climate change has become a very, very positive driver for the group. In our view, the utility sector is one of the only beneficiaries of the, and I'll stress this, global shift in focus on climate change. This is fueling momentum for companies to pledge to shrink their carbon footprint. And when I say that, think about things like retiring dirty coal plants or replacing pipelines that have leaks for methane. Within utilities, the retirement of old and dirty coal plants right now are being replaced by wind and solar projects, which can actually not only cut a company's emissions profile, but it actually reduces cost. The precipitous decline in the cost of wind and solar has allowed this swap to be very, very economic to the utility and can actually extend the earnings growth as the investment is made in these new facilities. How does this happen? Basically, what happens is the higher cost of coal plants, which you're already collecting in your rates, allows you to retire those and then fit these new wind and solar plants into your rates without any cost to the ratepayer. So not only do you get a higher reliability, but you get similar rates and you get a better carbon footprint. These next couple of slides I'm just highlighting from a Next Era presentation. They're one of the leaders right now in renewable development. As you can see, the levelized cost of wind on the left-hand side since 2012 has gone from about $40. It's now looking to be between $10 and $12. And if you look at solar, it's moved down from almost 100 down into that $25 to $35 range. We think that this will continue to improve. Lastly, the group has seen an expanding investment sponsorship, and this is very, very important. Again, I go back to, there's a global search for yield, and when I say real yield, this is yield minus inflation. We think the utility group offers a market-like total return of about 8 to 10%, and again, that's made up of 5 to 6% EPS growth and about 3.5% yield. You also have a positive climate change exposure, which makes the group very, very unique. Over the last 3 to 5 years, we have seen this profile actually get paid more and more attention, especially as global yields have gone lower, and we've seen foreign ownership increase in the group. People from Europe, Asia, and Australia have actually flocked into the group. And in the next slide, I'll show you the changes. But similarly, as financial products have, the cost of financial products have been also getting cheaper and cheaper. People have been looking to passive investments like ETFs as a way to actually invest in as opposed to just stocks. And what ends up happening is there's been a deluge of ETFs that have been created, whether it's income related, growth related, and then things like momentum, low volatility. But importantly, this ESG and climate change has become a big, big financial objective for many ETFs. We think this ESG climate change fund flows from ETFs will continue to support the group as active managers adapt to this new investor style, which will continue to actually help the overall group. Just on that point, this slide basically shows you kind of a listing on the left-hand side of the percentage of shares owned by non-U.S. holders. As you can see, one of the, your hometown companies, Wisconsin, leads the pack in over 20%. But again, you can see on average, the group is owned about 10% internationally right now. If you were to go back 5 or 6 years ago, this is probably closer to 2 to 3. And on the right-hand side, I'm just showing the increase in passive ownership. You can see, even just in the last 5 years, we've gone from something that was closer to, 20%. We're now approaching almost 30% in sort of passive ownership. And, small and large caps definitely reap the benefit of this. So the biggest question you've got asked since I've had this, positive view on the group is, why has the group been so bad recently? Underperformed the S&P 500 this year by almost 12.5%. This slide basically illustrates it. And as you can see, looking from left to right with the green sort of peak and then down to the right-hand side to the bottom, that's been the sort of underperformance of the group relative to the S&P 500. We think there's 5 or 6 main reasons that this has been happening. And, I would say probably the single largest one is the fact that as the people felt like we were coming out of, the COVID pandemic, investors were favoring cyclical stocks as well as tech, and they wanted to play the reopening of the economy. There's been concerns of hyperinflation due to too much stimulus and taxes. And another big issue also is the Fed's been actually buying back corporate debt and municipal bonds, which creates a safety net for these. I won't get into a lot of detail on this, but the volatility and the beta in the group spiked in March after the plunge. That's been something that has scared people. And then we've had a couple of utility-specific things. We had a recent bribery indictments in both Illinois with Exelon and in Ohio with FE. And then we also had a broken merger auction with Evergy. All these have been in the last couple of months. So recent trends in the group, I would say that, we think that these concerns and the market's fixation on cyclical, exposure doesn't make sense. I will start off by saying, what COVID? Most utilities are 85 to 90% back to pre-COVID sales levels on a weather-adjusted basis. It just hasn't been that big of a deal. COVID-related cost-saving strategies have actually changed utility workflows. Managements actually see the opportunity to carry a lot of the cost savings that they made to basically combat COVID into next year. This actually makes 2021 earnings actually more visible. These cost savings also continue to, again, fuel investment growth, making growth rates more secure. Again, the lower the cost they have, the more they can invest and the less that it actually impacts your bill. And then finally, the continued awareness of climate change is accelerating, and the deployment of renewables is helping this utility growth. NextEra just 2 days ago raised their guidance rate, extending their 6 to 8% growth rate to 2023. And this was all almost on the back of their strength of the renewable backlog and their view on how much wind and solar is going to be deployed over the next couple of years. So again, just to finish up, we think investors have little alternative for stable EPS growth, and bonds have significant inflation risk and trade pretty expensively right now. We think utilities are actually a great place as a core position in investors' portfolios. And again, we just reiterate our constructive view on the group. I won't go over them because I've talked about them, but I will move from there and turn this back to James and you guys for any sort of questions. Wisconsin.
All right. Well, thank you, James, for that excellent presentation. We do have some questions. If you, James, would click on your Q&A tab at the bottom of your screen. All right. Questions should come up.
Yep.
If there's anything there you want to respond to, feel free.
Sure. Okay, so the first question was, could you comment on the Pacific Gas and bankruptcy situation? Could you envision other similar unforeseen risks to other regulated utilities? Yeah, the quick answer on that one is I think you're already seeing it in Oregon and Washington. I mean, this really is a function of a structural issue. It's climate change. It's the need for more transmission, and newer transmission. So I don't see this being a widespread utility issue. I definitely see it being a geographic issue. Another question is what's your feeling about natural gas utilities? They seem to be in similar financial yield driven results. I actually, it's interesting. One of we like natural gas utilities. And the one thing about natural gas utilities is the fact that most of their capital expenditures have to do with making things more reliable and safety related. So again, there's no shortage of spending they're going to have to do. The one thing I will caution you on is the fact that with climate change, people view natural gas as the next coal. And so what people are afraid of is that natural gas is going to get phased out in basically being replaced by not only renewables, but also hydrogen. So we have actually seen these natural gas on a multiple basis. I would probably end up preferring having companies that have both electric and gas, as opposed to just total gas investments. Third question here was you mentioned energy efficiency affecting utility revenue. The utility videos do not show home solar installations. What are the utilities' attitudes about these ways to reduce CO2? Do they support it increasing? I think the utilities have actually supported, what this is really what's known as distributable generation. They do. The biggest problem that the utilities have is how do you deal with net metering? And what that means is that as you hook up your utility to, your home to a solar plant, they obviously are, they've already made an investment to actually serve your house. So how do they continue to recoup the previous investments they've made? The utilities are working through that on a regulatory basis to sort of work that out through this net metering. We think that, over the next 10 to 15 years, you're going to see more distributable generation. And we think that what that ultimately means is that your rates are probably going to be less volumetrically based, and they're going to be more based on a fixed charge as you see more people sort of, for lack of word, sort of move off the grid. And then finally, the last question was impact on utility returns if corporate tax rates increase under a Democratic federal government. Actually, we don't really see the returns changing that much. I mean, if you look in Wisconsin and Michigan, it's a pretty good example. Very progressive, very, very good, forward-thinking regulatory jurisdictions. Rates have gone from 3.5% on the Treasury rate, 5-7 years ago to less than 70 basis points now. But yet you've seen the ROEs, actually come down very, very slowly. If the tax rate goes up, taxes are actually a pass-through in rates for utilities, so they shouldn't really impact the overall return of the utilities themselves. What it will actually do is that will actually increase the cash flow to the utilities and actually help their credit. So an increase in tax rate actually will be a slight positive for the utilities overall.
Well, all right. Well, thank you again, James, for taking the time to be with us today. We really appreciated your presentation.